Fact, only 32% of Australians preferred online shopping before COVID-19. Now, Australia is 4 years ahead of the pre-pandemic and e-commerce projections, and that's rewriting the playbook for industrial property investors. Remember when online shopping was just a convenience, not a necessity? Well, those days are long gone thanks to COVID-19 lockdowns.
With bricks and mortar stores shut, Sydney's latest lockdown has again turbocharged the online market. And there are predictions the pandemic will change the way we shop forever.
Practically overnight, millions of Aussies had to shift their entire shopping habits online, from groceries to office supplies and everything in between. E-commerce demand caught retailers flat-footed and overwhelmed supply chains. But you know who was perfectly positioned to capitalise? Investors in industrial real estate. Let me show you the 3 major e-commerce trends that turned industrial property into a goldmine over the last few years. A lot of people assume the big e-commerce spike during COVID was just a temporary thing, right? That once lockdowns ended, we'll all go back to shopping in person like before. But the data tells a pretty different story. Before the pandemic, online shopping was still pretty niche. Only around 1/3 of Aussie households really preferred it over brick and mortar stores. Then COVID hit, and all of a sudden millions of us had no choice but to shift our whole entire shopping routine online practically overnight. Fast forward to 2022, and get this, a whopping 82% of Australian households made an online purchase that year. And projections show that a number could reach a staggering 98% by 2028. We're talking about just every household. The growth has been off the charts. E-commerce sales are up 113% since 2017. As of last year, online purchases have made up 18% of total retail spending across the country, almost 1 in every $5. So while the pandemic was a catalyst, this isn't just a short-term fad. COVID effectively accelerated e-commerce adoption by 4 years beyond what anyone predicted. What used to be a niche convenience is now mainstream, a fundamental shift in consumer behaviour. But those numbers are really just the tip of the iceberg, because while online shopping was booming for consumers, it created a frenzy behind the scenes in a totally different industry. Think about it. With so many more people ordering everything from clothes to furniture online, retailers had to scramble to have enough warehouse and logistics space to store and ship all these orders. It was like a sudden tidal wave demand that overwhelmed supply. In the real estate world, it takes years to plan, fund, and build new industrial projects from the ground up. So when the e-commerce explosion hit, vacancy rates for existing warehouses and distribution hubs just plummeted nationwide. Australia now has the lowest industrial vacancy rates globally at just 0.8%. Just about every square metre of space is filled up. With such extreme scarcity, landlords could basically name their price, which is why we saw industrial rents spike over 22% in 2023 across all the major cities. And the projections only reinforce that this supply crunch. Analysts estimate Australia will now need an additional 1.1 million square metres of logistics space by 2027 just to keep up with the e-commerce demand. So basically, the online shopping revolution triggered an industrial real estate gold rush. Now, you might be thinking, okay, that was a crazy couple of years, but surely the industrial property market is cooling off after that wild ride. Not so fast. While transaction volumes have slowed from those peak pandemic levels, we're actually seeing really healthy activity compared to historical averages. Total take-up of industrial space hit 2.9 square metres in 2023 across Australia. The investment dollars have dipped by around 26% this past year to $2.4 billion. But a big reason is simply lack of quality stock available to buy. Developers are holding tight, seeing the potential. Speaking of developers, they're doubling down on this e-commerce driven demand. The projected new industrial supply pipeline for 2024 is a record 4.5 million square metres going up nationwide. These guys aren't slowing down. They recognise that the convenience of online shopping has created a fundamental shift in consumer behaviour and real estate needs. Vacant space is still getting gobbled up quickly too. While vacancy rates have crept up about 7% from those dizzying lows, we're still sitting at only 42% of the 2021 levels across the country. Most of the areas remain pretty tight, with more supply urgently needed. At this point, you're probably thinking, okay, I get e-commerce is booming and industrial real estate is benefiting, but what's in it for me as an investor? How can I actually capitalise on these trends? Fair question. The opportunity here is all about positioning yourself in the right industrial assets that can ride the e-commerce wave profitably. And there are a few key things to look out for. First off, you want exposure to properties with strong rental growth potential. As tenants like retailers and logistics companies struggle for space, they'll be willing to pay up for quality locations. Landlords can keep pushing rates. Vacancy risk is another big factor. The lower the likelihood of prolonged vacancies at a property, the better protected your income will be. Aim for areas with sub 5% vacancy rates to mitigate that risk. You'll also want to target assets with upside for capital appreciation as this supply crunch plays out. Well-located properties in land-constrained markets could see a nice lift in valuations over time. And don't sleep on assets with renovation potential. Functional obsolescence is real, so properties you can reposition and modernize for e-commerce tenants will be in high demand. The name of the game is identifying those premium industrial assets that tick those boxes. It's an opportunity to generate solid rental income with capital growth upsides driven by sustained e-commerce demand. Look, at the end of the day, the e-commerce revolution sparked by COVID was a wake-up call for industrial real estate. While transaction volumes have cooled from those blistering pandemic peaks, this sector is far from falling back to earth. The data simply does not support this narrative. Despite rising vacancy rates, we're still sitting at levels 42% below what we were just 2 years ago. The reality is, the industrial property market is just recalibrating after a period of sustained overperformance since 2021. It's cyclical, a stabilization phase amidst long-term structural tailwinds. Those tailwinds are the enduring impacts of e-commerce adoption. Retailers will keep prioritizing urban logistics hubs for faster deliveries. Developers will keep expanding supply to meet that demand. So, if you're an investor looking to capitalize, don't get caught up in the short-term volatility. This is a multi-year opportunity fueled by fundamental market shifts. Of course, identifying those trends and identifying the right assets is crucial, which is exactly why for my next video, I'll be doing a deep dive into the performance of industrial property compared to office and retail over the past decade. So make sure you've subscribed and have notifications on because you won't want to miss that one. I'll see you there.